Welcome back to Fiscal Voyage. In this video, we're going to talk about a new position that I purchased because this stock went down, pretty large the past few weeks. So I bought some shares, the new position, and the stock that I'm going to cover today is Mondelez International Inc. MDLZ. So first off, if we go to the to my interactive broker, you can see here I bought MDLZ about 2 grand worth of shares at $60.85, and I'm up maybe about 2-3% now. Right now the stock is going for, if we go here to MDLZ, you can see here the stock is going around 62.60, and I got it for $60.85. So we're gonna go over why I bought shares of this company. So first off, we go to Fastcraft. You can see here, this looks great. They have some years where it's kind of flat years. You can see here, down 7%, down 1% here, 0% growth in 2010, things like that. But overall, the stock earnings has been growing around 4.76% for over the past 20 years. So that's something I really like. You can see here the graph is going very nicely. And if we put in the price, you can see here the stock tends to be valued around the 19.4 PE ratio, the normal multiple over this time period. And right now we're getting a blended PE around 18 with the price of 62.63. So I got a little better price, but I didn't, normally I like to go, 2,500, 3 grand into a stock. Because I think this could still go lower, and I'll show you why technically, and I also will show you why I bought shares of this company. But overall, this looks good. It looks kind of undervalued to slightly fairly valued. I wouldn't call it crazy undervalued, but it is a high quality company. It's been around a while, and it's been paying a dividend very nicely. They actually increased the dividend recently. You can see here has been a double-digit grower in dividends over the past since 2015. So I like that a lot. And if we go to forecasting long-term growth, they're expected to be growing around 5%. So that still looks good. If the company trades at a 19.5 multiple, you can have a 9% annual rate of return for a high-quality company, or a 21 multiple, 10.5%. Annual growth return annually. But that's why I didn't buy too much, because it could go lower, and I wanted, I have a start position because I always wanted to buy this stock, but it's always been, I find it always kind of overvalued. There's been opportunity, of course, during COVID here when it got down to a PE of 17. And over here, we got a PE down to 18.8. So that's kind of where I got it, a little lower than maybe 17.5 or so PE. But you can see here, during the Great Depression here, the Great Recession in 08-09, you can see here it got the lowest down to almost 12 PE. So that'd be great buying opportunity. But I could see it, going down to 50. If it goes down to 50, that's where I'll be loading up. $50 a share, that'll give me around a multiple of 15, so a PE ratio of 15, so that'd be great. But if we go to operating cash flow, you can see here the dividend is very well covered in operating cash flow, and free cash flow, the dividend is well covered. So overall, the dividend is safe. It has a nice payout ratio based on adjusted earnings around 50, so they have plenty of space to continue to grow the dividend. You see S&P credit rating of BBB, low debt to capital ratio of 35, so overall it looks good. Earnings yield, again, I like to see this at 6. I think I got it just at 6 when I bought it. And a dividend, very nice dividend at 3%, so I like that a lot. And we go to CFRA, you can see here they give it a hold rating but a price target of 72, 3-year projected earnings growth of 9, and you can see here, over here, they're expected, this year to have a nice growth compared to 2023, and in 2025, decent growth of 358 in earnings per share. And if we go to Morningstar, they get a 4-star rating, wide moat, and a fair value of 75 versus the last price, which is 62.63. So you can see here through Morningstar, it is undervalued based on Morningstar analysts. Now, if we go back to Fastgraph, the analyst scorecard is pretty accurate, so it's these earnings projections are pretty accurate, so I like that. Also forecasting here, normal multiple. If we go to a normal multiple, I like always to use this as the lowest one. So let's say 121.8. You can see here we can have an 18% annual rate of return if it stays in that area, which it possibly can, right? Because it's been in that multiple. It's got as high as 26 multiple over here, 24 over here, 23 and 25 over here. So it's very possible that we could see a nice run up, and that's why I bought some shares, not a whole lot, but I am waiting. Maybe if it gets to around $55 or $50, I'll buy much more, do it again. But that's what I like. Now we go technically, we can see here, if we go to MDLZ, we can see here why I bought shares. So if we go to the weekly chart, right over here, you can see I bought shares because of this strong support area right here. So that's why I bought shares. So last time it got into the $60 area range, it bounced all the way up to 76. So this is kind of why I bought shares here. But now the thing I don't like is, you can see here on the weekly, this is the 200 moving average. It bounced on the 200 moving average. It bounced on the 200 moving average. It bounced on the 200 moving average here during the COVID crash. But now it's under that moving average. So we could go up to here and then come back down. So this is why I said, it might come down, but that's why I didn't go all in. And you can see here on the monthly chart, you can see here, this is the 50 moving average. You bounce, great buying opportunity, great buying opportunity, great buying opportunity, great buying opportunity. You could think it was a great buying opportunity, but it broke it. And you can see here that moving average was very strong. So we have this moving average here that got broken. So it could get a bounce up to $65, $68, and then maybe fall back down. Now this is that reason why I want to buy in that $55, $50 area. We got strong support here in that area. Here we go here. That's basically strong buyers here. This 52 to 55. So this will be the next level that I'll be buying more shares of this company. As we saw in Fastcraft, that'd be great buying opportunity. It could possibly, I think, almost have a 4% dividend yield on a company that's growing dividend around over 8% or double digits since 2015. And if we go to the 3-month chart, this also goes in line with that $50. Here's the moving average on the 50 on the 3-month chart, and you can see here right on that $50, 49.48. Now obviously that's right now. This is gonna take time, and then this moving average gets higher and higher and higher to potentially to this area around this $54 area, and then this is where we'll bounce and go higher. So that's why I bought shares of this company. Not too much, right now is up 2-3%. It looks good. This if it takes over if it gets above this weekly candle over 64.50, it can push higher, because you can see here this is weekly. So this is about almost 3 months of down. So from $76 all the way down to $60.50, and that's about we go here, that is a 20% decrease. So at 20% discount from where it was 3 months ago, this is why I bought shares. High quality company, and you can see here in the fast graph, the chart looks great. The dividends are covered by operating cash flow and free cash flow. And we go to financial fitness here, you can see here free cash flow covers the dividends very nicely. Sales revenue has been increasing in recent years. Net income increased from 2022 to 2023. Operating cash flow is increasing as well, so that's all looks good. So this is why I bought shares of this company, and looking to buy more shares around that $55 to $50 area, and that'd be a great buying opportunity. So thank you guys for watching. If you're new to the channel, make sure you hit that subscribe button, and make sure you hit that like button for more videos like this, and I'll see you guys on the next one.